Welcome back to FT Markets. Formerly unloved and underfunded, Europe's periphery banks have staged a remarkable return to capital markets. National champion banks such as UniCredit in Italy and Spain's BBVA can borrow unsecured at low interest rates as fears of a eurozone breakup have receded. Lately, periphery banks like Ireland's Allied Irish and Spain's Bankia, which epitomise the crisis, are also being embraced by investors with the rekindled vigour of a once-spurned lover. But are investors blinded by their hunt for yield? Joining me to discuss this is Oliver Burrows, a Director of Credit Research at Rabobank. So, Ollie, we've seen investors increasingly prepared to lend unsecured to peripheral banks. Why is this happening?
Well, there's, as you say, a thawing of sentiment towards the periphery in general and the banks in particular, that began really with Mario Draghi telling everybody that he would do whatever it takes to save the euro, of course, in mid-2012. But there's also more of a differentiation, I think, in investors' work, what they've been doing in terms of which banks are worth lending to, essentially. And it's not just a broad brush return to we'll buy anything that's Irish or we'll buy any Portuguese bank debt. There is much more of a more credit work being done to decide who to lend to, essentially.
Absolutely. And we can see from this graph, this is financial institutions based in eurozone periphery countries. And although the red line shows that there has been a recovery last year on 2012 and the amount of bonds that have been issued, there's quite a way to go yet until we reach the heady heights that we saw pre the eurozone crisis.
Sure, but pre the eurozone crisis, you're talking about banking markets that were in a property bubble in Ireland and in Spain and more credit bubbles across the periphery. So you're not going to see a return to those levels. I don't think anybody really wants to see that because there is the bubble in chart form. But what we're seeing now is a return to normality. Of course, the banks are deleveraging, but they're borrowing what they need now for their current needs, which is a good thing. They're borrowing only what they need. They're not, which will help to provide credit to the real economy and to help stabilize the economies there. But these periphery economies are still in some difficulty at the moment, and the demand for credit is also fairly weak.
And of course, this has been driven, the rebound in bond issuance by peripheral banks has been driven mostly by national champion banks. But if we go on to our second graph, we can also see some of the more troubled banks such as Spain's Bankia, Portugal's BCP and Ireland's Allied Irish. These are the costs of insurance against their bonds, and we can see that their funding costs have also come down recently.
Yes, CDS spreads, as this indicates, have definitely tightened across the board, as they have across all of European banks. The bigger, more troubled banks have also tightened considerably. Again, for a number of different reasons. Across the board they have tightened, but the specific names have tightened for a reason. So Bankia's tightening reflects the progress it has made after having had such a disastrous time over the last few years. Its deleveraging, its removal of bad credits from its balance sheet has been progressing, still got some way to go, but again that's reflected in the price.
And of course, investors have been willing to take on increasing amounts of risk in their hunt for yield. If we go on to our final graph, we can see CoCo's so-called contingent convertible bonds, which offer high coupons but are also subordinated. Last year was a record year and we're on track for another record year this year. Why are investors increasingly prepared to take on the risks that CoCo offer?
It's an interesting question, and there are three buckets of risk that people are chasing at the moment, if you like. On the one hand, people are looking for more yield across the board, but you can get that yield firstly by going into periphery banks. Fine. You can go into the core banks, but that are still troubled, the RBSs, the Commerzbanks of this world. Or you can go further down the credit quality in terms of the ranking of the bond, so contingent convertible or subordinated debt, either in additional Tier 1 or Tier 2. And so far this year there's been plenty of issuance from both core names and peripheral names in all of those areas, in senior debt from the weaker names or the peripheral names, but also contingent, convertible and additional tier ones from BBVA and Credit Agricole. So there's slightly the less strong names within core Europe, shall we say.
And are investors mispricing risk, in your opinion?
Well, this hunt for yield is quite interesting because I think it does cause some blinding of the attitudes towards risk. Another way that banks have been enticing people into a decent return is to lengthen the tenor of the notes. So we've seen a lot of 12-year and 7-year issuance to be able to provide even the best credits at a decent enough yield. But yes, I do think that some of the yields on offer at the moment are not commensurate with the sort of risks that they're running.
Thank you, Ole. So, investors perhaps throwing a little caution to the wind in their hunt for yield, nevertheless on the back of an increasingly credible economic recovery.